If you're just buying and holding ETFs, then you're probably leaving thousands of dollars on the table. I regularly make $5,000 to $9,000 per month just with the ETFs that I already own. It takes about 60 minutes a week to do it. And if you wait until the end of the video, I'm going to give you a live demo of exactly how it works so you can start doing it too. Most investors just buy ETFs, dollar cost average every month, and then just hold them forever. And this information isn't wrong, it's incomplete. Because they don't know that every single month they could be making a consistent, predictable income with those ETFs. And if you take that income, even if it's small in the beginning, if you extrapolate that over 5 years, 10 years, this is hundreds of thousands of dollars that you might be missing out on right now. So instead of holding my ETFs, I sell covered call options on them. And don't worry, it's extremely simple. A covered call option is just a contract between two parties. You basically agree to sell your shares if they reach a specific price, and in exchange, the buyer pays you money, which is called the premium, as income for that contract. So that premium is always yours no matter what happens. And if you're worried about selling your shares, just understand that you're always setting your own price. So for example, if you bought your ETF at $100 just for simple maths, you are always setting your option at a higher price. So if the option ever exercises and you sell your shares, it's always at a profit. Let me show you exactly what I'm talking about. So this is Interactive Brokers. This is a paper trading account just for transparency, but the process is exactly the same. We're going to be using this to show you step by step how I do this. Before we jump into this, I want to just speak quickly about the 3 best ETFs. So not every ETF is built equal. The best one for this process by far is SPDR or SPY. And the reason for this is it's just extremely active when it comes to options. QQQ is also very good, and IWM, the iShares Russell 2000. This is more volatile, so you're going to get better premiums with this, but this is just the most reliable. If someone's going to be doing the strategy, it's normally with SPY. Let's go in. So I bought just SPY. Full transparency, you need a lot of 100. So it means you need to buy 100 of SPY to do this. So that's a 68,000 cost basis. But if you've been actively buying, dollar cost averaging, actively buying an ETF, then this is going to be amazing for you. Okay, all I'm doing is I am clicking here, and then I'm going to the options chain. So basically, these are the different amounts that we can get. So what the strike price is the price that we agree to sell it at. So we can choose a time period. So if we say, let's say 6 days from now, or even if you want to be more, if you want to just be more chilled out and just have this, once a month type thing, you can do it 29 days from now. And all you're doing is once a month. So basically what we're doing is we want to look, and what delta means is the percentage likelihood. So consider it the likelihood. So if we look at this, and for it to reach 686 in 29 days, there's a 50% chance. And as you go higher, the chance gets lower, right? But also the premiums that you make get lower. So if you look at this column, we're selling a covered call. So it's this column. You're basically, it's just balancing between the likelihood of your shares selling and how much you want to make. So in my case, for example, imagine this was significantly above cost price. Let's say the cost price was, somewhere down here, 680. So you really don't mind. You're even happy to sell it. I would just go one of these high things. So we could do this, 687, there's a 50% chance of it hitting it, and you're making 1,105. So the reason why is everything's times 100. So let's say I wanted this, it's going to cost me $11 to do this. I can either put a limit order, which is just saying this is the minimum I'm able to accept, or you can just do a market order, and that just matches you instantly. So let's say this, I'm happy with market, and I sell. It should go through, it just normally errors a little bit, but let's see if it's here. You can see here it's come through. So we have made $1,103 from that trade. So if it reaches 687, it's currently at 685. If it reaches 687, it sells. So let's calculate the potential profit on this. So we said 687. Let's say we got it at 681, for example. That's 6 times by 100. You're making a $600 profit on top of the 1,103. So if it exercises, you're making $1,700 in profit, which is great. I mean, it's free money. And if it doesn't exercise or if it doesn't sell, you just keep the 1,103 and then you do it again. You wait a month until this expires and then you just do it again and you make another $1,000 and then another $1,000. And that's how the process works. It's just a really easy way to monetize the ETFs. And all of these little things are just adding layers. So we said it was 1103 divided by the investment, which is 68,560 in this case. So all I did is I took this 1,103 and I divided it by the total investment I made, and it's 1.6%. So that's 1.6 a month. 1.6 times 12, you're talking about 19% that you can get above your normal returns. So I just want this to sink in, and you can see how incredibly important it is that you're actually doing this. So if you want my one-page investing plan that shows you how I make thousands of dollars every single month in just about 60 minutes a week, then comment stocks below and I'll send it to you. If you enjoyed this video, please like and subscribe. It really helps me, and continue watching. I'll see you soon.